Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, Sara Mehle, Index Research Strategist at Nasdaq Investment Intelligence, and Bryan Novak, CEO and Portfolio Manager at Astor Investment Management. They join us to discuss asset class and sector rankings with indices touching all-time highs and as market breadth widens out. It is great to have everyone back with us. It's Chuck, let's kick it off with you. A great time to be having this conversation. Dow hits 40,000. The indices have been hitting intraday all-time highs. I mean, the move has really been quite impressive.
Yeah, it really has. You figure we were just had a pullback back in April, about 5%, and really the market has moved straight up since then. I mean, looking at the overall trend of the S&P, I mean, it's hard to find anything wrong with it. It's above all moving averages. Looking at the point figure charts like we do, it's back in X's, never gave a sell signal during the decline. And so, yeah, like I said, we're at all-time highs now and everything's starting to look good. Also with breadth, like you mentioned, we're seeing, not just the biggest stocks are moving up, but, a lot of different stocks are moving up alongside of them. Breadth actually hit all-time highs before price did, which tends to be a good sign. That's, they call it a positive divergence. And usually when you see that, it means you've got some more room up ahead to keep growing. So we're hopeful for that.
All right. And Sara, give us an update on what you're seeing with the Nasdaq 100 and the comp.
Yep. So today, as you mentioned, we've seen new all-time highs. The Nasdaq 100, which is the top 100 non-financial stocks listed on the Nasdaq exchange, hit a new all-time high today on its point figure chart at 18,600 on its chart, but overall intraday high. But it looks to be breaking out of a range that it's been in this year between 17,000 and now this current breakout. So really like today's move. The composite is actually outpacing the Nasdaq 100 so far this year. And is also outpacing the S&P 500 this month. So the composite, all the stocks listed on the Nasdaq exchange, as you mentioned, breadth, that is a much larger group of names, but we are seeing both of these indexes rally and hit new all-time highs today.
So, Bryan, if we think about it from the fundamental perspective, complementing what Chuck and Sara have told us on the technical side, the market going into the year, we were thinking about 6 to 7 rate cuts. And with, tying the fact that we didn't get any and the narrative was so tied around what the Fed is doing, corporate earnings were quite good. Companies have really been managing this inflationary environment well. We're seeing breadth widen out. It kind of removes the Fed and the Mag 7 as being the catalysts from the market. So I think that aligns well with what they're saying in terms of, the divergence that we're seeing leading to the bullish side.
Yeah, I think that's right. If you think back to, let's take the example back to 2000, 2001. Everybody likes to do that when we're looking at technology. The cash position, the profitability numbers they're indisputably different now than they were back then. And especially the Mag 7, like you have so much cash on hand with these companies. And then if you also look at the small cap, because this has been a big area of like divergence so far this year, traditional small cap indexes versus, let's call it quality tilted or things that focus on profitability, they've done it like that's what you're concerned about, right? So forget the fact the market seems to be getting comfortable with the fact that we're going to get less rate cuts this year, but it's still pricing into that. We've seen the December Fed Fund futures measures right now, the tightest they've been since they started the rate hikes back in 2020 or 2021 or 2022. It's the tightest they've been. So we're getting comfortable with that. So as long as the economic data doesn't disappoint and we don't tip ourselves over, so as the labor market stays strong and you continue to see these trends through, like you mentioned, earnings, like if that keeps pace, I think we'll be in okay shape for right now.
Yeah. And Bryan, I think another thing is the market has come to terms with the fact that we're not going to go back to the interest rates that we saw when the economy is flush with liquidity, when we were at 0% interest rates. And I think the narrative has shifted. Should we get to that level, right? We have a bigger problem. That signals that the economy is in big trouble. Should we get back down to those rates, we're not going to see 2, 3, 4% again.
Yeah, nor should we, right? I mean, we've had disinflation. That was great. We had the summer disinflation last year, but now we're dealing with higher rates. We're dealing with a little bit higher inflation. The Fed does not want inflation that high. But the good thing is that the labor market's pretty tight. And we're not going to push ourselves into this stagflation idea, because that's the worst case scenario. Like, let's be honest, we're not going to get there, because any type of continuous push we get up there, it's a self-effacing thing. It'll start. Inflation might stay up for a little while, but I think that's the key. If we don't get any rate cuts this year, the market will definitely be somewhat disappointed by that. But as long as earnings aren't too detrimental to earnings, I think we'll be okay, at least for right now.
Yeah. And Chuck, let's switch gears for a moment here. What about in terms of sector performance? Not surprised to see technology at the top, but there are some surprises in there, perhaps.
Yeah, there are. We really we haven't seen much of a change in our rankings at the top, like you said. Technology is at number one. Industrials at number two. It's consumer cyclicals are at number three, and those are exactly the sectors you would expect to see to be strong in a bull market, right? They're historically the leaders. I would say the big surprise in this, at least in the last 30 days, has been utilities. They're still fairly low in our rankings. But they have jumped up quite a bit. I mean, they're now the best performing sector of the year. I think actually as of last night, up maybe 15%. And like I said, most of that is coming in the last 30 days or so, where it's up 11+%, and the S&P is up roughly 2 or so. So there's lots of reasons why that might be. There seems to be, people are starting to get, wind of the idea that, AI and all these technology companies are going to need more and more, power from the grid to train their models and all this type of thing. And that's I think a lot of people are positioning themselves, for that. Whether that's sustainable, it's hard to say. It's a weird place for utilities to be, because usually utilities are seen as a defensive sector, right? So, if I look back in history at other times where they've done, or had similar performance over a short period of time, it's typically at a bottom of a bear market, or let's say if we're coming off of a big bear market bottom. I don't want to say it's unprecedented, but it's definitely weird to see them doing so well.
Yeah. And Sarah, I'm sure you would agree as well, as much as you covered the Nasdaq 100 names that were leading the AI charge. I mean, we're going to have to power this, whether we're talking about AI, data centers, EVs, other sources of renewable energy that, is going to require more energy than perhaps our infrastructure can support.
Absolutely. I was just looking at year-to-date contributors for the Nasdaq 100's performance. And in terms of ICB industries, tech is up there at number one, followed by discretionary healthcare, and then utilities right there at number 4. And I believe on a quarter-to-date basis, it's the second most contributing sector right now to performance. And some of those names, I've looked into them. So Constellation Energy Group is one in particular. It has energy in the name, but it is considered a utilities play. And as you mentioned, those AI-driven names, I realized I didn't touch earlier on the Magnificent Seven. I can never say that. That we always used to touch on in our previous trade talks, but it's really been interesting to see some of these names really break out, while others have really started to pull back and lag. Names like Tesla, particularly.
Yeah. And Bryan, when you think about sectors, where are you turning your attention towards? Because we have seen, not that people are taking money out of tech per se, but they're starting to put some money that perhaps would have been on the sidelines or other sectors and moving into areas like energy. Financials was another one that we've seen perform well over the past 30 days.
Yeah, so just to touch real quick, so on the tech side in the sector, because we do look at sectors in our portfolio. So one area that we talked about breadth and talked about, looking sort of downstream. The interesting thing, because investors have wanted to play between the cap weighted indexes and then the equal weighted indexes to see if there's a trade in there somewhere. The GICS sectors this year, so info tech GICS sector is actually up about 19% this year. So it's outpaced the triple Qs by about 700 basis points this year. So if you really want to look at that and say that the mega caps are really carrying things, so that's not so much the case anymore. We are starting to see that broaden out. So if investors are really looking to see, okay, is it time to diversify? It's like, yeah, it is. There are other options out there from that standpoint. On the sector side, the energy trade is always tough because things have been very sharp in their moves and then retrenchment the last couple of years. So trying to time something like that it's a little akin to it's super tactical. But I think at this point, if you want to say that we're late cycle, energy tends to perform well late cycle, and if that's the case, like, you can get your arms around being involved in energy at this point. But I think that as we drive forward, if it's really going to be reliant on the consumer, and if the labor market holds up, like bouncing out between staples and services and discretionary will continue to be a positive trade, or should be, if the labor market continues to hold in.
Yeah, it's so interesting. And we talk about this from the economic perspective where, and we're in an election year. You're always thinking about what's at the forefront of the consumer's mind. And even though, let's call it, inflation has only, or is flatlined, round numbers here, right? 0% year over year, if that's the case. It's still up in many areas within that data. Let's call it 22 to 25% for insurance, for housing, for rent. So it doesn't feel like it is for the consumer. You're comparing pre-COVID to where we are now. And while we look at data points and we're extrapolating from here and there trying to justify these numbers, it doesn't feel that way for the consumer. So I'm wondering, it's been really hard to bet against consumers, but I wonder if they, that is going to come into play as this plays out some more.
Yeah, I think that if it does, I think that's a problem, truthfully, because if the consumer is if the consumer is the area of focus where things really start to be an issue, consumer spending is what's held us up. Manufacturing has started to tick back up. It's been non-existent for 2 years, and now it's finally, joining the party from the macro side. But if the consumer does start to retrench, that's going to be because corporate America is starting to see signs of something that's giving them indicators that they need to stop hiring, or they need to at least slow down. They haven't wanted to do that post-COVID because it costs a lot of money to hire a worker and then to retain them. So to let go of them, they just haven't wanted to do that, especially post-COVID. So if we do start to see that, I think that could be a warning sign, especially if the Fed doesn't get around to being able to cut rates in a meaningful way, because the amount of debt that's been picking up, and this is a debatable fact also, that revolving credit has picked up a lot in the last couple of quarters, and debt servicing levels are the highest they've been in decades right now, as far as the actual number, the actual rate. So that's where that could exacerbate itself. And we've had extremely tight, if you want to look at high yield CCC credit spreads, even investment grade spreads, they're super tight. The financial conditions are actually very accommodative right now, even though the headline rate is higher. Financial conditions have been very, very accommodative. So if you do start to see something slip there, I think that would be an area of worry, that you might start to see spreads start to widen out. Things get a little more challenging on the financial condition side. And you're getting a lot of duration risk even in tight credit spreads anyway. So I think you start to see investors starting to take a little more appetite out in that 5 to 7 year area of the treasury curve, because if you're going to get duration, you're going to buy credit. Is that what you're getting? You might as well take some higher credit quality.
Mm-hmm. And Chuck, what about international? How is that in terms of rankings?
Yeah, so international is number 2 in our asset class rankings. And, it's been there for a while now. I would say the interesting thing though is that it's starting to pick up of late. Really, I'd say the last 3 months, we've started to see international outperforming the U.S. And actually, international did very well during the April pullback in the U.S. It barely had any pullback at all of its own. In fact, it's up about, I think, a little bit over 4% versus 2% for the S&P over the last 30 days or so. And like I said, been outperforming on the 60, 90-day periods as well. A lot of that comes down to emerging markets in Europe. When you look at emerging markets, I think, especially the last, 90 days or so, the story's been China. They've just, rocketed straight up with the kind of the easing of financial conditions there. Whether or not that's sustainable, it's hard to say. They're still well below their peak in 2021. I think maybe 50% below the peak. So it's certainly a bear market rally for them. And it's showing signs of getting a little toppy here. But there's also been a lot of strength out of Europe. The places like the UK or Germany have all seen, double the performance of the S&P, here in the last, really like 2 or 3 months. Hard to say exactly why that is. And part of me thinks it could be because, investors are seeing or hoping that the European Central Bank cuts before the Fed. It seems to be a common refrain that we hear, and markets are picking up on that. So yeah, it'll be interesting to see. There's been a lot of cases in the last, let's say, 15 years where people have called for a new bull market in international, and it materializes for a little bit, but then never really comes to fruition. But I think it'll be interesting to see this time if it has legs.
Yeah. And Sarah, to wrap up here, anything that you're seeing in ETFs that reflect what Chuck was saying in terms of international picking up a bit here?
Yeah, so just in terms of indexes, as Chuck mentioned, in April, we saw the international indexes outperform. The Nasdaq Emerging Markets Index was the best performer among the Nasdaq Global Indexes that we review, rose about 1.1%. Another one that we saw that I was able to outperform the group, the Nasdaq Asia Pacific ex Japan Index, was up about 20 basis points, but was the only other index that gained in April. But yeah, we're seeing emerging markets showed definitely more resilience than their developed market counterparts, at least in April. We review these group of indexes on a monthly basis. So this is ending April 30th, but again, emerging markets, best performer among that global index group.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.